Now that we've ordered breakfast, we will get started. People will probably turn up halfway through it, but that's okay. Today we're talking about the changes to superannuation, particularly how they impact on everybody, not just accountants. And so I've got a general advice warning at the start. Obviously I don't need to give that to my own authorised reps, but it says that today is a talk about superannuation, and I'm going to give you some ideas. Those ideas are not intended to get you to make a decision to do something or a decision not to do something. It says here that before making a decision, you should seek advice from your accountant or a financial planner, and that's really it. So any strategies, make sure you take advice before making a decision. So what we're looking at today is all the changes to super and how they impact. First thing that we all need to understand is you now can't take super until you're 57. And I think that mistake's been made a bit over the last couple of years because people still have 55 in their head. Remember, every 2 years, it's going up until just before I turn 60, the age will be 60. So I'm missed out by 45 days of being able to get my super before I'm 60. Not that it matters, not that I'm going to want it before I'm 60, but the rule now is that you've got to be 57 to take it. Don't make that mistake. Okay, the other rules, there was a few other rules that were brought in. The accountants, obviously you know it, some other people may not. The major ones, $25,000 is the maximum now you can put into super and get a tax deduction. When Paul Keating was the treasurer, I forget when that was, I was a whippersnapper, a 35-year-old could put $35,000 into super. So we're talking 1991 here. Now that person who is 60 odd can only put $25,000 into super. Why have they gone and reduced it so much? The concept of super is to save the government the age pension. That's really all it is, isn't it? So we want to save the age pension, so we will allow people to have tax concessions to put money into super. If you take a 65, soon to be 67-year-old getting the age pension, what's the single age pension? 18 grand a year? So it's 180 grand over 10 years. It's 360 grand over 20 years, so we're 85, we've received 360,000. So realistically, they would not expect to have to pay anybody more than $400,000 of age pension in their entire life. So why do we give tax concessions for millions? To save $400,000 in age pension. So that's the philosophical argument about reducing the tax concessions for super. We'll talk later about how, yep, we can get around that. We can still get you your 15% tax without using super. We'll talk about that later. But that's the reason that they're limiting the amount you can put in. Thankfully, they've made the number $1.6 million. They haven't said, well, above 400 grand, you're on your own. They've made it 1.6 million, so that's good. So 25,000 is the maximum you can put into super and get a tax deduction. Of course, the super fund then pays tax on that amount of 15%, but you get a tax deduction. Beneficial if you're in a 30-cent tax bracket, not so beneficial if your marginal tax rate is 0 or 15%. You can put $100,000 in and not get a tax deduction. So before 2007, you could put 100 million into super and not get a tax deduction, but they limited the amount you could get out. And Alan, we had clients that were in this problem, didn't we? Specifically where they had lots of money in super, but to take it out they were going to pay a lot of tax. 2007, they changed it to limit the amount you could put in, but make unlimited what you could take out. So there are a lot of people that got a massive advantage on that day that had a lot in because the rules were you could put unlimited in, but couldn't take much out, to suddenly all that amount just converted. Those people still have that money in super. It's still concessionally taxed, but now we can only put $100,000 a year in, and we can only put that money in until we've got $1.6 million in super. So if you've got 1.59 in super, you can put 100 grand in, but next year if that amount's over 1.6, you can't put non-tax deductible contributions in. So that would suggest from a strategy point of view, put those contributions in as early as possible. And I've got some numbers showing the difference that a person could accumulate in super by putting their non-concessionals in their 30s instead of their 50s. And I've done the modelling of that, and we'll get to that later when we run through. Now, for the first time, this is a really good strategy, if you have a job and your employer puts, say, 10 grand into super, you can put the amount up to $25,000 and get a tax deduction for that amount no matter what you do. You can now actually top up yourself. So you can, a family trust or your spouse could have a job, you might be self-employed, and then you could distribute to them out of your family trust distribution and they can put that into super. That's a really good strategy to allow people to do that. Well, those of you in the room that have a taxable income beyond $250,000, you'll be paying 30% contributions tax on the money you put into super instead of 15%. So you're still 18% in front. People go, why would you do it? It's still worth doing it because you're 18% better off. You may all remember the superannuation surcharge. I think that was in the 90s. That was based on an income of $90,000. They abolished that after a few years because it was costing more to administer it than they were receiving. Now they've upped it to $250. I don't see how they're not going to have that same problem. I don't think they've learnt from history, but we'll see how that happens going forward and how much money they get. So that's all of the major contribution rules. We will talk about the pension changes separately. Some of the smaller changes that won't have a major impact on your clients, but will certainly have some impact. We can now get a spouse contribution if your spouse is earning up to $37,000. Used to be about 12 grand that you could get a rebate. It's now up to $37,000. So what does that mean? It means that if you've got a higher income, your spouse has got a lower income, you're approaching retirement, you can put $3,000 into super on behalf of your spouse and you will get a $540 rebate for that. So when you're close to retirement, that is a no-brainer. If your spouse is 63, you get the money back in 2 years and you've got an 18% guaranteed rate of return immediately. So spouse contributions most certainly should be looked at, especially towards retirement. The low-income superannuation contribution is now the low-income superannuation tax offset. Think about a person that's on a low income paying 0 or 15, or what is the lowest rate now, 17% tax, their marginal tax rate. They put money into super. They pay the same tax in super as what they would pay in their own name. Where's the financial incentive to put money in super? There's none. And we want people to put money in super when they're young because that has a massive impact when they're older. So they've actually said that they'll refund the contributions tax up to $500 for those people. So their effective rate of tax on the money going into super becomes 0. So it makes it worthwhile. And the government will make super co-contributions where you are not self-employed, because obviously self-employed people can lower their income. So if if you're employed, you want to put money into super, they will match it up to $500. And again, that's useful for someone that's 63. I mean, if you got $1,000, put it into super, you get a $500 hit. It's free money. Probably wouldn't use it if you're 30 and you've got a mortgage, but certainly you would consider using it when you're older. The big one, however, are the pension changes. I've certainly surveyed all our accountants and we think it's about 3% of clients that are going to be impacted by this change. All the talk is about it, but there's very few people that actually, where a husband and wife or them have more than 1.6 million in super. It's very rare. It's going to change going forward, but it's only going to be a small number of people where this is impacted. And if it was a room full of the punters rather than us accountants, then we'd be talking, very few of them would be impacted. So from the 1st of July, we're now past the 1st of July. When you move from accumulation in your super, so those of us that are under 65, we're putting money in super each year. The idea when we turn 65 or when we retire, that could be earlier or later than 65, we then live on that money and hopefully it lasts us until we die. And then if there's anything left, it goes to our kids. So the idea is that when we turn 65 or thereabouts, we start taking a pension. The government in 2007 gave us this wonderful, wonderful incentive to start pensions in that there is no tax on it. So you got $1 million sitting in your super fund. That $1 million, let's say it earns 5%, that earns 50 grand. Super funds currently pay tax on that. You won't pay tax on that. So that saves you money. The money you pull out of super is not taxable. It's not assessable. It's not even considered income, which is really, really good if you move overseas. Now, why is it really good if you move overseas? If I decide to retire in Bali, I pay tax on my worldwide income in Indonesia. So if I was receiving income from Australia in the form of franked dividends, then I pay tax on those dividends in Indonesia without a franking credit. If my superannuation pension from Australia was considered income to me and I lived in Bali, I pay tax on that pension in Bali. Same as if you go to America. My brother-in-law lives in America. He has $20,000 sitting in a Macquarie super fund. He's now an American taxpayer, all that stuff. He pays tax on the earnings of that super fund in America. So he has to put the earnings of his super fund into his tax return in America. He can't get the money out of super. If it goes up in value, so his member statement goes from 20 to 21, $1,000 increase in super, he pays tax in America on that $1,000. So we've looked at all sorts of strategies. Where's your life insurance? Yeah, it's in that super fund. How much it costs? Not much. His wife's a nephrologist. He doesn't need life insurance. So it's difficult. So you need to be careful of that if you're going to move to America. If you're going to move to America and you've got super, be careful. Make sure you declare it. You know what Americans are like. You go to jail if you don't declare income on taxable income over there. I'm not an American tax expert. So that's tax-free. The money that's not in pension phase, you pay 15% tax on the earnings. So the $1 million, if it's in pension, there's no tax on your 50 grand earnings. So no tax on that. So $50,000. Over here, if it's in pension, you'll pay 15% tax on those earnings. So it's $7,500 tax. So it's a reasonable sort of balance. I know we've got clients that I've previously dealt with that have $10 million in super. And that would have all been in pension phase by now, I'd imagine now. So that would have, all the earnings on that would have been tax-free. Now it's 1.6 for mum, 1.6 for dad, and the rest of it, they pay 15% tax on the earnings. So now we've looked at that 15%. So if you retire with $3 million in super, you can't take a pension with the whole $3 million. You can only take a pension with 1.6, and the extra 1.4 has got to stay in accumulation. But what happens is with that 1.6, if you pull money out of that, so you take a lump sum, you might pull 500,000 out, you get a credit. So you've got this debit and credit balance system running for the rest of your life on that 1.6. And so if you only take 1.3, then in 3 years' time, you can take another 300. But if the 1.6 has gone to 1.7, you can't take another 400. What they say is you took 13/16 of the cap, so now you can have 13/16 of the. It's really complicated. So good luck to anyone trying to calculate it. What's happening now is because of all this balancing, super funds have got to go and tell the tax office what you're doing all the time. So you've got to notify the tax office. It's more work for you guys. It's more work for your accountants to notify the changes to the pensions. So there's a lot of advice to go in that and a lot of modelling for the 3.5% of your clients that are going to be beyond the 1.6. They're there, but there's not many of them, but it's a lot of work for those people. So, and we'll look at some modelling on the pensions a bit later on. So they're the changes, that's it. There's not too much. It doesn't impact a great deal of people. I know I used to contribute 35 grand a year. I'm now back to 25, so it certainly had an impact on me. There's no doubt about it. But at the same time, Ben's just turned 18 and I have family trusts. So all the accountants in the room are smiling and congratulating me. For the non-accountants, a family trust that has investment or business income can be paid to my family. And once your family are over 18, they pay adult rates of tax. Ben's in full-time education. I've got to pay his school fees. Here's a distribution from my trust of $14,000 to pay his fees. I don't pay tax on that, he does. How much tax does an 18-year-old pay on 14 grand? One of the accountants in the room, it's pretty easy, it's zero. So it's quite beneficial that I've got that. now we've got to look at strategies, and a lot of the strategies only impact on the 3.5% of the population, but I've also got strategies here that impact on the rest of us, even strategies that impact on Ben and decisions that Ben needs to make now when he starts working and puts money into super. But whenever we do modelling, does anyone know what the tax rates are going to be in 2035? No. Does anyone know what rate of return we're going to get between now and 2035? No. Does anyone know what super laws will be? No. Does anyone know how long their clients are going to live for? No. There are websites. You can punch in your date of birth. It'll tell you when you're going to die. I'm certain I've died at least twice by now, ones I've done in the past. So whenever we give advice, we can only give advice based on what we understand and what we expect and what we know, but things could change. I often have people say, oh no, I don't like super. Super might change, so therefore I'm not going to take this advice. Well, doing nothing is still doing something, isn't it? Saying I'm not putting the money in super because they might change the rules means that you're paying your marginal rate of tax on those investments forever. And if super doesn't change, then hindsight would say that that was a ridiculous decision. I had a phone call from a client earlier on this week who wanted to come and get some advice about taking his $250,000 in super, moving it to an SMSF, and gearing that, buying a property up to about $600,000. This guy, I don't know his age talking to him, but he was at most 44 and probably in his mid-30s, just talking to him over the phone. And he was asking the costs, and the cost to do that ended up at about $10,000. And he was and then he said, oh, wow, that's really expensive. I don't know if I want to do that. I said, so what you're telling me is this is going to cost you $10,000 to gear your super from 250 to 600,000, make a tax-free capital gain on 600,000. Now let's say you do that for 20 years. What was the average price of a house in Camden 20 years ago? Curran's Hill will choose. I know what it was because I was in the market. It was 180 grand. How much is it now? 600? 7? More. So you've got 4 times your money. So you've got 600 grand now for 20 years. It's going to be 2.4 million. In a super funded pension phase, what's the tax? 0. If you decided you didn't want the 10 grand in fees, do it in your own name. What's the tax for an individual making $1 million capital gain? 250,000. So what you're telling me is you don't want to spend 10 grand in fees now to save 250 grand tax in the future. It's just, fair enough if you think I'm too dear, go and get quotes from other people. But remembering these fees included the bank's costs, the solicitor's costs, the advice fees, setting up a corporate trustee of the Bear Trust. So he can't save any money on that 10 grand, but by all means go and have a look. So we're going to give people advice. We're going to say, this is what we recommend. Things could change. I know that, you know that, but we've got to base the advice on what we know today. So strategies for everyone. The power of compound interest. How many 25-year-olds do you think know what portfolio their super's in? Just give me, let's run an auction. Let's start it at 0%. Does anybody want to raise me to 1%? I don't even have an opening bid at 1%. Okay? So in a room full of accountants, we have 25-year-olds and we've agreed that 0% of them understand what portfolio they're in. Okay. Knowing that they've put their money in super and 0% of them have made any decision as to what portfolio they're in, how many do you think are in a cash portfolio? Now I'll start that at 20%. Does anyone want to raise me on 20%? I would think more than 20%. I would think that we're probably closer to 50% because a lot of funds put you default into the cash portfolio for one reason only: it will never go down. They're never going to have someone going, holy crap, my super went down. I don't like that fund. I'm moving it out. Now, if it's not a cash portfolio, it could then be a balanced portfolio. Rightio? So on the assumptions we're making, one of those assumptions is that cash will give you CPI plus 1. Low growth will give you CPI plus 2, balanced CPI plus 3, growth CPI plus 4, and high growth CPI plus 5. So let's look at that this 25-year-old, we'll say their 25-year-old has got 20 grand in super. So we'll leave that 20 grand alone, it's 20 grand in super. if they're in a cash portfolio and they leave it there until they're 65, we all know the formula, don't we? It's principal times 1 plus the interest rate to the power of the number of years. We all know that. There's no bells and whistles in this number. So we're taking 20,000, we're multiplying it plus 1 plus the interest rate to the power of 40. Now the interest rate will be over the long term dependent on the portfolio you chose, but we're going to say cash is 3%. So $20,000 at 3% per annum over 40 years equals $65,000. Fantastic. Most people will go, I've got 65 grand. I'm happy with that. I've done nothing with it. But let's say we move from the cash portfolio to the balanced portfolio. Instead of getting 3%, we're getting 5%. So now, $20,000 invested for 40 years at 5%. Remember cash was 65 grand? Guess what we're at now? $140,000. 2.5 times the amount. And now this is mathematics. If you don't believe me, stick it in Excel. It's pretty simple. But now let's move from the balance to the high growth fund. $20,000, 7% rate of return, 40 years, we are within an umpteenth of $300,000. So this is real. This is real. $20,000. Now, of course, in 40 years' time, the value of $300,000 is not going to be what it is now. Think of, 300 grand now, what was it in 1970? It was going to buy you a Point Piper mansion. I understand that. But it's 65 grand in cash. It's 300 grand in high growth. And my notes on the slide says, what are you telling your children? Because your children don't know where their money is. A decision they make today that requires them to tick a box and go, put me in the high growth portfolio, can have 4.5 times more money in their super when they're 65. Because how much effort will your 30-year-old child go to save 0.5% per annum on their mortgage? They will fight tooth and nail to save 0.5%, but will do absolutely nothing to get 0.5% more in their super. When you've got a mortgage, you've got a reducing benefit every year, haven't you? Because hopefully you owe less and less every year. When you've got a super fund, you've got an increasing benefit every year. So the benefit gets better as time goes on. In a mortgage, it gets worse. Make sure you speak to young people and tell them to get advice on their super. It's really important. Now, max contributions. Alan, this is the one that you were talking about putting 25,000 into super. If you're 50 and you've got 300 grand into super, what hope have you got getting to 1.6 million? You're going to have to do non-concessionals. So getting to that balance is going to be too hard. And again, I've modelled this out and I've got a spreadsheet that I can show you. But we use the example of Melissa, and in part of our assumptions, I've assumed that they're going to have a high growth portfolio because we've already spoken to our younger people, we've given them the advice, and we're going to assume a 7% or CPI plus 5% rate of return long term on their super. So let's look at Melissa again at age 25 with $20,000 in super. And I don't know how this is going to be possible. Actually, I do know how this could be possible, but Melissa's going to put $25,000 a year into super now. She's going to put the max contribution. Now, I have a daughter called Melissa, and how would she be putting $25,000 a year into super when she's 25? It's pretty simple, really. I'm just going to make her a family trust distribution if she's got a job and tell her to put it into super, because that's going to be tax effective to me and I'm looking after her retirement. That way I can spend all my money when I'm 65 and go and party and not have to worry about what I'm left with. Now, if Melissa puts $25,000 a year into super at age 25 and keeps going until she's 65, earns 7% and inflation's 2%, she will reach the pension cap at age 63. Now, at that point in time, the pension cap will be $3.4 million, going up 2% a year. So you can reach the pension cap if you start at age 25. So, yeah, not many people are going to start contributing. And I would agree, I'd probably be better off distributing 25 grand to Melissa and having her pay it off a mortgage than putting it into super. I understand that. So it's probably not going to happen. We're just modelling it to show what can happen. So at age 63, Melissa would reach the cap. Now, what if she waited until she was 30? So let's say Melissa's done medicine, rightio, and she's popped out and she's earning a really good living at age 30. And doctors tend to marry doctors. So if Melissa waited until she was 30, then at age 65, she would only be at 85% of the cap. She still can't get to the cap. So if you look at your high earning clients, the 5%, this is why it's not going to impact many people. Because if you've got a surgeon at age 32 that starts earning 800 grand to $1 million a year, they're not going to be impacted by the caps. Because, they will be actually, we'll talk about non-concessionals. Now, if Melissa started at age 35, at age 65, she'll be at 67% of the cap. That's all. So at 35 to 65, now most people, I believe, that at 25 now will be working well beyond 65. Forget that concept of 65. I think they'll be working well beyond, so they'll be contributing right up until 70 and may have more chance of reaching the cap. So yeah, like you said, a person now that's younger, I've got absolutely no hope of reaching the cap unless I bought Bitcoins a few years ago and the Bitcoins. When is super not worth it? Everyone just assumes super's always good. It's less tax, so it's not worth it. So consider Peter, who's 77 years old, rightio? Or we probably would say the remaining spouse in an SMSF or just in super. And he's got 600 grand in super. A lot of us would say leave that in super because you pay less tax. Let's say it's all in pension phase and it's all concessional. So Peter's 77, he's got 600 grand in super in pension phase. Now, on our assumptions, we said he's going to live till he's 83, rightio? If it's a lady, we would average 85. So let's say 10 years. Let's say you're going to live for 10 years. He's got 600 grand in super. What's he going to earn on that money? We're saying 5% in retirement, 30 grand a year. Okay, it's in super. He's earning 30 grand a year. He's got $1 million in super, because that's a no-brainer to get that out of super, isn't it? Absolutely, $600,000 in super. He pays no tax in super. How much does he pay tax out of super? 0. How much fees is he paying in super? $6 grand a year, 1%. Could he get it for less than 1%? Yes, he could in an SMSF. Might be down to 2.5 grand a year. But if he's paying a retail fund, it's 1%. So he's paying 6 grand in fees. Now, it's concessional contributions. How much tax does his kids pay when he dies? 15 to 17%. So around $100,000 in tax his kids will pay when he dies. Should Peter have this money in super? Absolutely no way in the world. Absolutely no way in the world. 600,000 tax-free money in super. Should he have it in super? No. If it's non-concessional, so in other words, the kids get it tax-free, you would have to consider whether he would or wouldn't, because what we've just agreed is that there's no tax outside of super, but there's $6,000 a year in fees. So again, Peter may be better off outside of super. If he was in a high growth portfolio paying him 7%, 8%, 9%, he may be better off. You need to model it. Let's say he's got $1 million in super, all concessional contributions, earning 5%, so earning 50,000 a year, no tax inside of super. What's the tax on 50 grand, I think, for a retired person? 8 grand? Okay, so he's paying $8,000 a year on tax if he takes it out. How much is he paying in fees? That's 1%. He's paying 10 grand in fees. So he's paying 10,000 in fees, he's paying 8,000 in tax. If he dies, his kids pay 150,000 in tax. It really now, everyone keeps coming to us saying, well, I've got to get advice on the 1.6, but we'll leave the excess in super. I'm saying that's fine if you're 65, but once you start getting older, around that 75 age, you've seriously got to consider pulling your money out of super if it's going to go to adult kids who will be paying 15%. Who doesn't pay 15% tax on your super when you die? Your spouse, a financial dependent, or a child under the age of 18, aged 18 to 25, still in full-time education, or over 25 with a disability. Yeah, everyone else pays 15 to 17% tax. Why do I say 15 to 17? If you pay it to your estate, it pays 15, it can give it, there's no extra tax then when it comes out. If you pay direct to your kids, it's 17%. If you have made a binding death benefit nomination to a super fund and you've said pay it to my adult children instead of to my estate, you've just cost them 2% tax. Imagine if that's 600 grand. You've just cost your kids $12,000 in tax because you made the wrong binding death benefit nomination. Who takes advice? About 50% of people. The other 50%, they don't care. $12,000 in tax because they wouldn't spend $1,000 to get advice as to where to pay it. You don't see it, but what you're saying to me is you care more about the tax office than your children. It's okay with SMSFs. You could burn that binding death benefit nomination, considering it is to the kids and they go, no, I don't want to get it. You could burn that. In theory, a child could also renounce their right to get that beneficiary, because effectively a distribution from a trust to a beneficiary is a gift, and a person can reject a gift. So they could say, no, I'm rejecting that. I don't want it. You're not to pay it to me. And then they would go, well, it's been renounced. We don't want to pay that, so we want to pay it somewhere else. That's what we do with family trust gifts. We renounce them. So you really need to do some modelling for your older clients, because most people in the room have clients, about whether they should have their money in super or not. If it's an SMSF with a direct share portfolio and they've got $1 million, it's 0.2% per annum in fees. It's very low. However, if it's in a retail fund, it's going to be 1%. If it's in an industry fund, it is 1%, because you don't get a reduction in your fees as you get a higher balance in an industry fund. You're paying the same. In a retail fund, once you're over 500 grand, they throw fees away. Whereas in an industry fund, they keep going up and up and up. Remember that. What could Peter have done? So Peter's died, okay, and now his kids are paying $100,000 tax because Peter hadn't taken any advice, and they're spitting chips, saying to the accountant, why didn't you say something to Peter? Or they're spitting chips thinking, wow, he should have taken some advice, shouldn't he? What could he have done? Okay, if Peter retired at 64 and a half, he could have pulled 300,000 out and put it straight back in as a non-concessional contribution. Then when he died, he would have saved him 50 grand in tax. Amazing. That one decision, $50,000 savings in tax he could have done. That's if he wanted to leave it in super. So if he died at 68, we probably would have said, keep it in super. If he came to talk to you at 65 and a half and he's already retired, he can't put it back in. Too late, you're already 65. But at 64 and a half, he could, and he's retired, you can't pull it out at 64 and a half if you haven't retired. At 64 and a half, he could have pulled it out, recontributed, and then he would have saved 50,000 to his kids. But let's say he was married and had a wife at that time. He could pull the 600 out and put 300 in each. Halve that super, 300 each. Immediately commence pensions. When he dies, no tax to the kids. Would have saved $100,000 in tax. Is that worth $1,500 in advice? I would say yes in a heartbeat, because it's too late once it happens. You can't go to an accountant and say, how do we get out of this $100,000 in tax? You can't get out of that $100,000 in tax. You are stuck with it. Take some advice and you can get out of that tax. Let's say Peter had that money and he was expecting to draw down and then die with 300,000. Then he wanted to give that to his kids. Why couldn't he take that 300 and give it to his kids early, or sit it in a mortgage offset account for his kids and go, if I need it, I'm going to take it, so that you're not paying that lump sum tax, you're not paying any tax on the earnings, and the kids are getting it anyway. If you're going to die with 500,000 in the bank, what has that done? So that person might be able to use that money for their children's benefit long before they die. A lot of people go, I don't care about the kids, they're looking after themselves, and I accept that, that's fine. But often what you're saying is, I don't care about the kids, so the money's going to the tax office. Do you really care more about the tax office than your kids? Now we'll look at the people that are impacted by the $1.6 million cap. So we're only now talking a small percentage of the population. And so we will talk about nephrologists, gynecologists, surgeons, barristers, but we've all got some clients that are high income earners. You mightn't have many clients impacted by the caps, but you've got a lot that earn hundreds of thousands of dollars a year. I know that, I see it all the time. We're going to talk about Peter again. And we're going to say that Peter's 35 years old, is an ultra high income earner. So he's on 250 grand a year or more, but he's only just started earning this money. So he's still only got 20 grand in super. He's got a lot of after tax income, but we're definitely going to tell him to make the maximum contribution every year. It's a no-brainer that he will continue to make that. Now we know from dealing with Melissa earlier that at 35, Peter's only going to get to 2/3 of the cap by the time he's 65. So we want to get more money in super, definitely. So the only way we can do it is for him to put non-concessional contributions into super to get him up to the cap. So for those of you that don't understand too much, he's going to put $25,000 a year into super. And in today's money, he's only going to get to $1 million by the time he's 65 with a 1.6 cap. So he's going to have to put his own money into super. Remember, you can put $100,000 a year in of your own money until you've got 1.6 million. Then you can't put your own money in anymore. So we're going to tell him to put his own money in to get him up to that and maybe beyond that 1.6 million. So we're putting 25,000 plus we're going to put 100 grand. Now what we're going to say to Peter is you're going to put the $100,000 a year in straight away. Now we know he can bring forward, but because we're going to be doing over the long term, we've just modelled it at 100,000 a year. Each year, 100,000. So 25,000 with a tax deduction, plus another 100,000 each year without a tax deduction. So he might be a surgeon, he's got to put it somewhere. So we're saying into super. He's still got more money on top of that, but into super. Peter reaches the cap at age 46. So he can only put $100,000 a year in for 11 years. Then he reaches the cap. Then it's gone. He can't put that in anymore. Now he's got to do something else with the money. At age 65, Peter has $7.2 million in super. He reached the cap at age 46. That's in 10 years' time. But that money continued to make earnings. Remember we looked at Melissa with her $25,000 till age 40, became $300,000. Peter's put 11 years worth of non-concessionals. He's managed to get $1.1 million into super, plus he's putting 25 grand a year in. He's done it early. He has the power of compounding going right through from age 46 to age 65 on that money. He has $7.2 million in super at age 65. That's pretty good. That's all in a low tax environment. All his other wealth is outside of super. Now remember, this is 30 years time from today. $7.2 million is not going to buy you a waterfront property at Point Piper in 30 years time. That's not what it is worth today, but it's still going to be worth, and we can model that out to work out today's money at 2% inflation, but the number is $7.2 million. But let's say we'd decided that Peter shouldn't put $100,000 into super at age 35 because it's locked up until you're age 65. You can't get that money. So what we're going to do is we're going to do what most people do, and we're going to wait until you're 50 to put in your non-concessionals. So I'm going to put $25,000 a year, age 35, 36, 37, 38, 39, 40, 1, 2, 3, 4, 5, 6, 7, 8, 9. Now that I'm 50, I'm getting closer to retirement. I'm 15 years away and I got money. So I'm going to start now taking money and putting the $100,000. And then I'm going to reach the cap and then I'm going to stop doing it. Now Peter reaches the cap at age 59. So when he was 35, he could put 11 years in and he reached the cap after 11 years. Now that he's 50 and doing it, he can only put it in for 9 years because all those 25,000s he's been putting in has increased his balance. So it's not going to take as much time to get to 1.6 million. That cap will be 3.5 million by then. But so he's going to reach the cap in 9 years. So he can not only do non-concessionals at the limit for 9 years. When Peter's 65, he's got 3.9 million in super. So remember, we were at 7.2 million in super if he did it from age 35. Now, the assumption I've made here as well is that you can still only put 100,000 in. I don't think they're going to make super better. I don't think they're going to start allowing us to put more in. So he could only put 100,000 in at a time, with the cap going up by CPI, $7.2 million in super if he does it from 35 to 46, $3.9 million in super if he does it from 50 to 59. If you're dealing with 35-year-olds that are high income earners, you need to show them this modelling. You know, we've learnt now about getting into a high growth portfolio young and the benefit of that. That's way more than the benefit of compare the pair. When they do their comparisons, someone saves 70 grand. But what if you stay in their cash fund? You've taken no advice. You've watched an ad on TV. You've moved over to an industry fund. No problem with industry funds. But you stayed in the cash fund. So you've saved 70 grand in fees, but cost yourself 350,000 in investment returns. You need to take advice. We've looked at that. We've looked at when you should contribute. We've looked at making non-concessionals early if you're a high income earner. Another big one that we get a lot of requests for is your business premises. So Chamber of Commerce, a lot of us want to own our business premises. Do we put our business premises in super or have it outside of super? I've had 2 clients in the last 6 weeks that have come to me specifically for advice around buying their business premises and whether or not they should buy it in super. One I said yes, the other one I said no. Why would I say no to someone buying their business premises in super? How much capital gains tax do you pay usually on the sale of your business premises? It's a pretty easy answer. 0, right? Because we have the active asset exemption. So how much tax savings do you make on the capital gain putting it into super? Nothing. So there's no tax saving putting it into super. What negative gearing benefit do you get on a property in super? 15%. What negative, provided you've got taxable income in the super fund. Otherwise it drops below. What negative gearing benefit do you get on a property in your own name? Your marginal tax rate. So if your marginal tax rate is over 15% and you're not paying capital gains tax, you can see that you're actually better off having that property in your own name than you are in super, aren't you? Because you're getting the negative gearing benefit. But then you might say to me, but Pete, what about in 15 years' time when it's positively geared and now they're paying tax on the rent? We move it to super. And in New South Wales now, guess how much stamp duty we pay? $500 if it's geared, $50 if it's not geared. So you keep it in your own name for 15 years, negatively geared. Fantastic. I'm getting a great negative gearing benefit. I've got all the depreciation. I'm not paying rent, most likely, because I'm going to own it, or my company's paying rent to me. I do that for 15 years. I then sell it to my self-managed super fund. I make a capital gain, no tax. And if I'm over 55, I don't even have to contribute that gain to super. So there's no tax putting it into super and nominal stamp duty. And now it's positively geared. I'm paying rent to myself and I'm getting a tax deduction for the rent. Whoa, that's pretty cool, isn't it? So what about the client? We said, yeah, put it in super. He was buying an older property and he was paying cash. No negative gearing, no depreciation, and he was contributing the cap and he wanted to contribute more. So yeah, we buy that business premises in super. You contribute your 25 grand, your wife contributes her 25 grand, and you pay another 40 grand in rent to your super fund. $90,000 a year going into super where he wants it to be. And he was over 50, so he's going to pull it all out again soon. So business premises inside or outside of super, it is not an automatic yes. It is let's look at your circumstances, take advice and decide whether we do it. Now the other one is life insurance. People automatically think you do life insurance through super, don't they? Yep, that's our automatic assumption. However, that's not the case. Let's take the most ridiculous example that we could take. Let's go back to Peter, who is 35 years old, has 20 grand in super, earns heaps of money, and therefore has a big life insurance policy. He has issues, which means his life insurance is costing him $25,000 a year. So he's contributing $25,000 a year, paying that all in life insurance. How much super does Peter retire with? 0, doesn't he? Because his superannuation contributions are being eaten up by life insurance. So Peter's better off putting his 25,000 in super, taking outside super money and using that to pay for his life insurance. Another negative of life insurance, I have life insurance in my fund for my adult children. They will pay 17% tax on the death benefit paid to them if I die. So why would I do that? I need to have more life insurance. The financial modelling is there to show that a maximum contributor to super who is on a 32% or higher tax bracket is financially better off paying their life insurance outside of super. The modelling is where they pay their life insurance through super and the money outside of super is invested. If that money outside of super is not invested but spent, they're actually way better off paying their life insurance outside of super. There are there's certainly some rules around that. For example, if you were paying the money outside of super off a mortgage, there's no tax on the earnings. It may be better off outside of super. But it's where you're investing the money outside of super, then you are better off paying your life insurance outside of super. I pay my life insurance outside of super because of forced savings. It means that my life insurance premiums are coming out of my own money. My super is building more rapidly in a tax-free environment. So don't ever automatically think that life insurance should be paid through super. There are a lot of circumstances where it should be outside of super. Now, finally, for the super wealthy people that are putting all their money in super, where do you put the excess? So I'm only allowed to put 25 grand in super. Peter at 46, he has met the caps. He can only put 25 grand in super. He can't put another 100 grand in super each year. Where does he invest his excess money? We have lots of options, don't we? You can invest it in your own name. You can invest it through a family trust. You can invest it through a company. Now, the accountants in the room, if I said invest it through a company, would say I'm wrong, wouldn't they? Because we're putting an investment portfolio in a company. And why do we not put an investment portfolio in a company? Because of capital gains tax. Now I've got a trick question for you. How much capital gains tax does an individual pay on a capital gain made by a company? It's a trick question because people say capital gains tax. A company pays 30% and the maximum an individual pays is 23.5%. That's what we say, don't we? But let's take an example of somebody who bought in a company 20 years ago the property at Currans Hill for $180,000. They bought it in a company. They've just retired, okay? Just retired, and they have $2 million in super. So we now know that this is less than 5% people that will have that much in super. So they've got a maximum $2 million. So they bought their property at Currans Hill, and you as an accountant took over this client. They had their investment property in a company, and you started tearing your hair out because it's in the wrong place. So they got their investment property, it's in Currans Hill, and they just sold it for $800,000, and they bought it for $200,000. Let's easy numbers. $600,000 capital gain, $180,000 in tax, right? So let's call that $200,000 easy numbers. So there's $400,000 of profit after tax left in the company. How much would they have paid in their own name? 600 grand, you get them in the top marginal tax rate. So what you're saying is you're worse off because you've now got $400,000 of after-tax profit. You've got $200,000 tax. You only would have paid $150,000 in your own name. But let's actually look at this a bit more closely. We've got a company with $400,000 plus however you funded the 200 grand in the first place, which could be a loan, whatever. But let's say we've got $400,000 of franked income, and the company's owned either by mum and dad or a family trust, probably by mum and dad. So mum and dad have retired. That was their investment portfolio. They got an amount in super under the cap that's paying them a pension. Starting next year, what's mum and dad's marginal tax rate? Zero. So let's say starting next year, we were to pay them a $30,000 franked dividend each year. How much capital gains tax will they pay on that capital gain? Zero. So where would they have been better off having that property in the long run? In the company or in their own name? In the company, right? Way better off. Way better off. Did that accountant advise them to put it in a company 20 years ago, understanding what was going to happen in 20 years' time? No way in the world. But now they are way better off with that investment in a company than they are in their own names. So we are now almost exclusively telling clients to invest their investments in a company. Let's go back to Peter at 35, who's a surgeon. He can only put 100 grand in super. He wants some other tax stuff. So what we say to Peter is, or let's say he's 45 now, Peter, go and borrow $1 million against your house, okay? Against your house. And invest that $1 million in 1 million shares in a private company, okay? And that private company is going to buy an investment portfolio. It could be an investment property, happily. Buys an investment property, brand new one with depreciation. So the company owns the property. What's it going to earn in a year? $1 million, what's that? 40 grand in rent, but with probably 30 grand depreciation. So it's going to make 10 grand a year. So what we do so that we don't raise the ire of the tax office, we pay that 10 grand each year as a fully franked dividend to Peter. Peter's borrowed $1 million, he gets the 10 grand dividend. We all understand he's getting the full negative gearing benefit of that property, right? The full negative gearing benefit, because he's borrowed $1 million, he's negative gearing that property. And as that goes through, it probably gets a bit better. We may not distribute the whole profit because we might want to reinvest into another property. You would get away with that, but you've got to distribute something so he negative gears. Peter comes to retirement, he's negative geared that property all his life, hasn't he? But now how much tax is he going to pay on the income? It could be nothing. Better still, let's say Peter decides that that investment company is just going to build wealth for the next generation. It's just going to stay there and build wealth for the next generation. Just keep reinvesting it for my grandkids. When he dies, he leaves those shares to a testamentary trust. So Peter's dead at 85. We now have a company with $5 million in it, owned by a testamentary trust. He has 8 grandchildren. How much tax will have been paid on the earnings in that company over the long run? 2.5% under current rules. Why? Because that company will pay 30% and only give a 27.5% franking credit. However, over the long run, that will wear itself back to 25%. So you could actually have Peter negative gearing the investment in that company for 30 years and then paying no tax on the earnings to his grandkids in the future. The testamentary trust is there, can distribute to children. There is a way to get rid of all the tax. Investment companies are actually brilliant. Brilliant. You could even have that company, if it wasn't a negative gearing scenario with Peter where, hey, we don't need negative gearing, you could have that company owned by a family trust, okay, and take that money out through a family trust, 18-year-old Ben. But then later on, I still set up my testamentary trust, and then that family trust can distribute to the testamentary trust and go to my grandkids. So I can still go up and across. Now, this is high-level stuff. The accountants understand it, non-accountants don't. But what it's saying to you is that for these people that have got big estates and they've got a lot of money to worry about for the next generation, you've got to get the advice and structure it correctly, because for $3,000 or $4,000 in advice, you can save $1 million over the term of your grandchildren's life in tax quite easily. You've got to take that advice.